For decades, $1 million has been the magic number for retirement. It was the financial industry's greatest marketing invention. A simple, powerful, and deeply resonant goal. Save $1 million, and you can live comfortably for the rest of your life. It was the American dream, distilled into a single number, a symbol of financial success, a finish line. But that finish line has moved. And if you're still aiming for $1 million, you're aiming for a target that no longer exists. Because $1 million is not enough, not even close. It's a trap. A cruel joke played on a generation of savers by a financial industry that sold them a lie. Let's do the math. The traditional rule for retirement is the 4% rule. It was created in the 1990s by a financial advisor named William Bengen. It says you can safely withdraw 4% of your portfolio each year without running out of money. The idea is that your portfolio, invested in a mix of stocks and bonds, will grow by more than 4% per year on average, so you can live off the growth without touching the principal. So if you have $1 million, you can withdraw $40,000 per year. That's $3,333 per month. Can you live on that? Maybe. If you have no mortgage, no car payment, and no debt. If you live in a low cost of living area. If you don't travel, if you don't have any expensive hobbies, if you don't get sick. But here's the problem. You will get sick. Healthcare is the single biggest expense in retirement, and it's the one that nobody plans for. The average 65-year-old couple retiring today will need about $315,000 in savings to cover healthcare costs in retirement. That's after Medicare. That's just for premiums, deductibles, and out-of-pocket costs. So your $1 million nest egg is now $685,000, and your $40,000 annual income is now $27,400. That's $2,283 per month. Can you live on that? Probably not. And that's not even the worst part. The 4% rule was created in the 1990s, a time of high interest rates and low inflation. It was based on a portfolio of 60% stocks and 40% bonds. But today, we live in a world of near zero interest rates and stubbornly high inflation, which means the 4% rule is broken. Most financial advisors now recommend a 3% or even a 2.5% withdrawal rate. So your $1 million portfolio, after healthcare costs, is now generating an income of $17,125 per year. That's $1,427 per month. That's not retirement. That's poverty. This is the $1 million retirement trap. It's a number that sounds big, but in reality, it's not enough to live on. And the financial industry knows this, but they keep selling you the $1 million dream because it's an easy number to market. It's a simple goal that everyone can understand, but it's a lie that has lulled millions of people into a false sense of security. A lie that is about to come crashing down. So what's the real number? How much do you actually need to retire? It depends on your lifestyle. But a good rule of thumb is to have 25 times your annual expenses saved. So if you want to live on $100,000 per year in retirement, you need $2.5 million. If you want to live on $150,000, you need $3.75 million. If you want to live on $200,000, you need $5 million. These are the new magic numbers, and they're a lot bigger than $1 million. So how do you get there? You don't get there by saving. You can't save your way to $5 million on a normal salary. You get there by investing. And not just in a 401k or an IRA. You get there by investing in assets that generate income. Real estate, a business, dividend stocks. You get there by building a machine that prints money for you while you sleep. Because the old model of retirement is broken. The model of working for 40 years, saving $1 million, and living off the interest is a fantasy. It doesn't work anymore. The rules have changed, the numbers have changed, and if you don't change with them, you're going to be left behind. $1 million is not a finish line. It's a starting point. And if you're just starting to realize that now, you're already behind. Let's dig deeper into why the 4% rule is so dangerous in today's world. The rule was based on historical data from 1926 to 1976, a period that included the Great Depression, World War II, and the high inflation of the 1970s. It was designed to be a worst-case scenario, but the world has changed. The bond market, which was the safe, stable part of the 60-40 portfolio, is no longer safe or stable. With interest rates near zero, bonds don't provide the income they used to. And with the Federal Reserve printing trillions of dollars, the risk of inflation is much higher than it was in the past. This means that the safe part of your portfolio is no longer safe, and the growth part of your portfolio, the stocks, is more volatile than ever. This is a toxic combination for retirees. It means that you are taking on more risk for less return. It means that the chances of running out of money in retirement are much higher than the 4% rule would suggest. A study by Morningstar found that in today's market conditions, a 4% withdrawal rate gives you a 57% chance of running out of money in a 30-year retirement. That's a coin flip. Are you willing to bet your retirement on a coin flip? And it's not just the market that has changed. We have changed. We are living longer than ever before. A 65-year-old couple today has a 50% chance that one of them will live to age 90. That means your retirement could last for 25 or 30 years, or even longer. The 4% rule was designed for a 30-year retirement. But what if you live for 35 or 40 years? The rule breaks down completely. This is the reality that the financial industry doesn't want you to see. They want you to believe that you can just put your money in a 401k, set it and forget it, and everything will be fine. But that's not true. The 401k is a deeply flawed system. It's a system that is designed to enrich Wall Street, not you. The high fees, the limited investment options, the tax-deferred trap, it's all designed to keep you on the hamster wheel, working and saving until the day you die. So what's the solution? The solution is to take control of your own financial destiny. The solution is to build your own retirement plan, a plan that is not dependent on the whims of the market or the promises of the financial industry. A plan that is based on assets that you control, assets that generate income, assets that will be there for you, no matter what happens in the stock market. This means real estate, it means a business, it means a portfolio of dividend-paying stocks. It means anything that puts money in your pocket, month after month, year after year. This is how the rich build wealth. They don't rely on a 401k. They don't rely on the stock market. They rely on themselves. They rely on their ability to create value, to solve problems, and to build income-producing assets. This is the new retirement. It's not about a magic number. It's not about a finish line. It's about a process of building a life that is not dependent on a paycheck, a life that is not dependent on the stock market, a life that is free from the fear of running out of money, free from the control of the financial industry, free to live the life you want, on your own terms. This is the real American dream, and it's a dream that is still within your reach, but you have to be willing to do the work. You have to be willing to challenge the conventional wisdom. You have to be willing to build your own ark before the flood comes, because the flood is coming. And the $1 million retirement is the first thing that will be washed away. And to write. Let's really get into the weeds on this, because the devil is in the details. The $1 million figure wasn't born from a sophisticated financial analysis. It was a marketing gimmick. It first appeared in the 1980s, a time of booming markets and conspicuous consumption. It was a round, aspirational number that sounded impressive. It was the financial equivalent of a luxury car or a Rolex watch. It was a status symbol, and the financial industry, in its infinite wisdom, realized that it was the perfect tool to sell you their products. Mutual funds, annuities, life insurance, all of it was packaged and sold as a way to reach the magic $1 million mark. But the world of the 1980s is not the world of today. In 1985, the median home price was $84,000. Today, it's over $400,000. A new car cost $9,000. Today, it's over $48,000. A year of college tuition at a private university was $5,000. Today, it's over $40,000. $1 million in 1985 had the purchasing power of about $8 million today. So if you're still aiming for $1 million, you're aiming for a target that is almost 3 times smaller than it was when the goal was created. And then there's the 4% rule. The rule's creator, William Bengen, has himself said that the rule is no longer safe. He has warned that in today's low-interest rate environment, a 4-5% withdrawal rate is the absolute maximum. and even that is pushing it. He has also pointed out that the rule was based on a 30-year retirement, and that for longer retirements the withdrawal rate needs to be even lower. But the financial industry continues to promote the 4% rule because it's simple, it's easy to explain, and it makes their products look more attractive. It's a classic case of marketing trumping reality. Let's talk about the sequence of returns risk. This is the dirty little secret of the 4% rule. It's the idea that the order in which you receive your investment returns matters a lot. If you retire at the beginning of a bull market and your portfolio grows by 10% or 15% a year, for the first few years of your retirement, the 4% rule will probably work just fine. But if you retire at the beginning of a bear market and your portfolio loses 20% or 30% in the first few years, you are in big trouble. You are withdrawing money from a shrinking portfolio, which means you are selling more and more of your assets at lower and lower prices. This is a death spiral from which it is very difficult to recover. And with the stock market at all-time highs and the economy on the brink of a recession, the risk of a bear market in the near future is very, very real. And let's not forget about taxes. The 4% rule is based on pre-tax returns, but you have to pay taxes on your withdrawals from a traditional 401k or IRA. So your 4% withdrawal is really a 3% or a 5% withdrawal, depending on your tax bracket. And as we've already discussed, tax rates are almost certain to be higher in the future than they are today. So the tax bite on your retirement income is only going to get bigger. This is the perfect storm that is brewing for a generation of retirees. A perfect storm of low interest rates, high inflation, a volatile stock market, longer life expectancies, and rising taxes. A perfect storm that will wipe out the retirement savings of millions of people who thought they were doing everything right. People who played by the rules. People who saved their money, invested in their 401ks, and dreamed of a comfortable retirement. People who were sold a lie. The lie is that you can outsource your financial future to Wall Street. The lie is that you can just hand over your money to a bunch of strangers in suits and they will take care of you. The lie is that you can be a passive participant in your own life and everything will work out in the end. It won't. The only person who is going to save you is you. The only person who is going to build a secure and comfortable retirement for you is you. And the only way to do that is to take control, to become an active participant in your own financial life, to become an investor, not a saver, to become an owner, not a consumer, to become a creator, not a cog in a machine. This is a fundamental shift in mindset. It's a shift from scarcity to abundance. It's a shift from fear to empowerment. It's a shift from being a victim of the system to being the master of your own destiny. And it's a shift that you have to make if you want to survive and thrive in the new economy. The $1 million retirement is dead, and it's not coming back. The sooner you accept that, the sooner you can start building a real retirement. A retirement that is based on reality, not on a marketing gimmick. A retirement that is based on assets, not on a magic number. A retirement that is based on freedom, not on a fantasy.